Hello and welcome everyone to another market commentary from StashAway. With us this week, our Deputy Chief Investment Officer, Stephanie. Stephanie, how are you?
I'm good. How are you?
I'm very well. How's everything in Hong Kong?
It's getting hotter and hotter, but everything is it's good. COVID numbers are under control here. Things are reopening. Hopefully, it will happen everywhere as well.
Yeah, no, absolutely. So that's good to hear. Good to hear. Well, we got a lot of questions for you over the last 14 days since our last recording. So I suggest we jump right into them. And the first one is actually from Jen Ming Teo. And the person is asking, hey, Stephanie, you touch on different types of inflation during the last market commentary. Could you give us as a simple summary of how we as investors in StashAway should react or not react vis-a-vis for each type of inflation?
Yeah, thank you for this question. So we've talked quite a lot about inflation in the past 2 months or so. And I think if you think about inflation, there are indeed different types of inflation and then also different magnitudes of inflation. So let's just go through them maybe one by one. So in terms of types of inflation, there are broadly two types. One is a supply pull, supply-driven inflation, i.e., for example, during past energy crises like oil crises or like during war periods, you see commodity prices shooting a lot higher because of supply side issues. And then on the other side of that, we have demand driven inflation. So demand driven inflation happens when the economy is strong, right? When activities are actually picking up and people demand higher prices for the goods and services because there's a lot of demand for that. So it's important to think about what kind of inflation we are seeing if we when we talk about inflation. And then the other magnitude, the other dimension is the magnitude of the inflation. So as I said briefly in the last commentary, we are entering a period of sustained higher inflation, which is roughly 2 to 3%. But this is still very moderate if you look at the full inflation history. So, for example, the US or elsewhere in the world, we have seen inflation figures as high as in the high single digits, or in a hyperinflation scenario, even higher than that. So 2 to 3% is actually a pretty good, I would say, kind of more moderate, higher level of inflation. And we say it's higher because in the past 12 months or so, we've seen very low inflation, especially because of the reduction in demand from COVID. So when we think about what kind of inflation we're going to experience in the next 12 months or so, I think it's a mix of both demand and supply. So from the supply side, we do see still bottlenecks in terms of logistics. So I mean, this actually adds to the pressure in providing the like the goods and the upstream commodities, which adds to the cost of providing them. So that is partly supply driven, but also there's some demand driven pressure upward on wages and prices as well as economies reopen, as vaccines get rolled out, and as people go back to work and activities resume to normal. Think about inflation in terms of these two types and also the magnitude.
Yeah, no, thank you for that detailed answer, Stephanie. I'm sure the person will really appreciate that, and a lot of our listeners as well. Moving on then to a different topic, and two people are asking a somewhat similar question, right? So Vasi H as well as Leung Chong, I want to know a little bit more about China tech, right? So I'm just going to read out one question of the two, but they're roughly the same. It says, hey, Stephanie, can you talk a bit about China's crackdown on education tech sector, right? KWEB was one of the ETFs we use, has holdings like TAL and EDU, which has taken quite a beating recently. First of all, that's the first question. And then it follows up with, can you share your opinion what to expect from governments, or the Chinese government in this case, over the next 6 months to 1 year on Chinese tech giants such as Baba, Tencent, Baidu, JD, because everyone is kind of afraid of who is next in line to get like kind of like a slap on the wrist, right?
So I guess to answer Vasi's question, on the educational tech side, it's I guess if you look at the sector as a whole, it's obviously down a lot. TAL, for example, is down 70% year to date. Some other companies are down in similar veins. I guess the concern here is that China government is looking at the education, like the private tutoring sector, and really trying to come up with new regulations which may impact the revenue of these companies. They're still going through the investigation, and there is no kind of update as of now yet. But there are concerns in the market that they may come up with like pretty drastic measures, like, for example, limiting tutoring just to weekdays, so no more tutoring on weekends or public holidays. A lot of this is uncertain though, so there's a lot of uncertainty in the sector right now, which is why you see stocks taking a beating. If you look at the educational sector as a whole, though, a lot of hot money or a lot of investments has gone into it in the past few years. And I mean, these stocks have gone up a lot, right? So in StashAway, we don't invest as single stocks or even single kind of subsectors, because it's actually pretty risky to do so. On the upside, of course, it's great, but unexpected events happen, and I mean, all these stocks take a beating. So in StashAway, we primarily invest in the China Internet ETF, which is a well-diversified ETF across over 50 different Chinese technology companies. And even if you look at just the top, I guess the top 10 companies, these are like Baba, Tencent, Meituan, listed in different jurisdictions. Some are listed in US, some are listed in Hong Kong, and they are across different subsectors. So having that ETF allocation actually helps you to diversify within the Chinese internet sector. And I think of course, right now the tech giants are kind of in the eye of the storm, i.e., a lot of scrutiny right now. But there are certain subsectors, or there are certain companies within the whole broader sector that could also benefit in the long term from this current crackdown. So, for example, I think one of the biggest news this week was Didi being penalized by the Chinese authority, and I mean, stocks are down a lot. But I mean, Didi is a monopoly in China, right? And if they need to kind of if the Chinese government decides to crack it down, rein it in, then it opens up opportunities for other players. For example, Meituan may benefit from it. So I think on a single stock level, it's very, very hard to time these things. Like, you don't know when the government is going to go after or what they're going to go after next. But I think, as we said before, there are certain practices in the industry that are not healthy for the industry. Like, for example, for a long time, Baba and Tencent forces their customers to choose one platform over the other. Right? If you work with Baba, you can't work with Tencent, which is not very, very healthy for the industry. So after the current round of regulatory changes, I mean, we do think that the Chinese internet sector as a whole is going to get a lot healthier. The problem right now, of course, is that there's a lot of uncertainty. Right? You don't know like what the new regulation is. I mean, there are, I guess, analysis or estimates in the market, but nobody knows what the final result would be. But one thing for certain is that when the final regulation comes out, I mean, that creates certainty, right? And in equity markets, in risk markets, when there's certainty, usually that's when like the worst is priced. So for the educational sector, for example, when they come out with the final regulation, then I mean that creates the certainty that market likes.
No, absolutely. Thank you, Stephanie, for that. And thank you both for those questions as well. Very interesting for probably a lot of the listeners and users of StashAway. And to wrap it all up, Stephanie, we have one last question for today. It's from David Chang. He says, hey, I've been hearing people discussing about Basel III again lately. May I have an explanation what that is and how that may impact the price of gold in general?
Yeah, so I mean, Basel III is a regulatory framework for banks. and there have been discussions about some changes to Basel III, which would affect the risk weighting that banks put on gold. So when a bank have some assets, have some risky assets, they have to have safe assets to offset that risky asset. So I won't go into like the whole like nitty gritty details of that, but in a more kind of top level, there are two major changes. One is that for physical gold that a bank holds, the risk level is going to be lowered, right? So that is actually positive for physical gold, i.e., the banks actually can more easily hold physical gold. On the other side, there's something called unallocated gold, which are gold that are held by the bank, but it does not belong to the bank. So let's say, if a client has some gold and that's stored with the bank, that is classified as unallocated gold. And the upcoming Basel III changes basically says that for these unallocated gold, because it's basically client assets, so the bank has to set aside more reserve for that. So all in all, how does it impact gold? There's a lot of noises, right? Some analysis says that it'll benefit a lot the demand for physical gold. Some analysis says that it'll actually disrupt the whole gold market. Our view is that if you think about paper gold versus physical gold, i.e., what determines gold prices? Actually, there is a lot of derivative paper transaction in non-physical gold, i.e., you don't see gold bars changing, right? You see like gold futures or like OTC contracts being exchanges, and these volumes far exceed the actual transaction in gold bars. So indeed, in fact, if you look at, for example, what's traded in London Gold in terms of contracts, it easily trades easily 10 times of gold is traded at 10 times the trading volume of gold versus the amount of outstanding gold is easily 10 times or more. So are these changes going to be affecting gold market a lot? I think you have to step back and look at does that affect the whole kind of derivative or paper gold market? It shouldn't have a big impact. So our conclusion is that there will be changes, technicalities for the bank, but it's not going to have a big impact on gold.
On the investor. Well, thank you so much, Stephanie, for that, and David for asking that question. To wrap it all up then for everyone, we do have some amazing webinars coming up as always in all the different locations where we are. So in Singapore on the 14th of July, if you want to join us for our Investing for Women webinar, that's from 7 to 8 p.m., 14th of July. Again, for all of the ones that I'm mentioning now, you can find the links to sign up for those in the show notes as well as on our website. For Malaysia, we have What is Your Financial Plan B? That's also on the 14th of July, 6 to 7 p.m. local Malaysia time. In Malaysia as well, we have a second webinar the week after. It's called An Inside Look into StashAway, 21st of July, 2021, 6 to 7 p.m. as well. And in our MENA region, we have our Financial Planning Basics webinar, also on the 14th of July, 6 to 7 p.m. Again, as always, links in the show notes, as well as on our website and anywhere else you interact with StashAway. With that being said, thank you for being here, Stephanie, and thank you all for listening. And we will be with you again in a very short amount of time. So until then, have a great day. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.